Jernard Trust here. In this video, I'm going to break down the best high yield savings accounts for 2026. I'm going to cover four things. First, what the actual savings account actually pays right now compared to what the best ones pay, and the gap is bigger than most people think. Second, how these accounts work and whether your money is actually safe in them. Third, the specific accounts paying the most today with their real minimums and their real catches. And fourth, the three traps to cause people to open one of these accounts and still earn less than the rate that they were promised. So let's get into it. Let's start with the gap, because the gap is the whole reason why this matters. According to the FDIC, the average annual percentage yield across all savings accounts in the United States as of July 20th, 2026 was 0.38%. That is the national average. Every savings account at every insured bank averaged together. Now, here's the part that should bother you. Many of the largest national banks pay far less than that average. JP Morgan Chase, Bank of America, and US Bank all pay 0.01% on their standard savings accounts. Meanwhile, the top high yield savings accounts available right now are paying around 4.20%. Let me put actual dollars on that. If you have $10,000 sitting in a Chase savings account at 0.01%, you earn $1 a year. $1. At the national average of 0.38%, you would earn $38. And at 4.20%, that same $10,000 earns you $420 per year. That is 420 times more than the big bank account for the exact same money sitting in an account that is just as safe. And I want to be specific about why it's just as safe, because that's the first question that people ask. A high yield savings account at an FDIC insured bank carries deposit insurance up to $250,000 per depositor, per institution, per ownership category. That is the identical federal protection your local big bank account has. If the bank fails, you are covered up to that limit either way. So where does the extra yield come from? It's not coming from taking more risk with your deposits. It comes with operating efficiency. Most of these high yield accounts are offered by online banks. With no branch network, no tellers, no physical real estate, they pass a chunk of that saved overhead back to you as interest. That's the entire mechanism. There are two real trade-offs, and I want to name them honestly. The first is that these rates are variable. The APY you open the account at is not locked in. If the Federal Reserve cuts rates, your yield drops with it. That is different from a certificate of deposit where the rate is fixed for the term. The second is access. Most of these are online only, so there is no branch to walk into, and savings accounts have historically carried a 6 withdrawal per month limit, so that this is not where your day-to-day spending money should live. This is for your emergency fund and your short-term cash. Now let's get into actual accounts, and I'm going to work from the more familiar names up to the highest rates in that order. Capital One's 360 Performance Savings pay 3.00% with advertised rates effective as of June 2nd, 2026. There is no monthly service charge and no minimum balance required to open or maintain it. Ally Bank and American Express both sit at roughly 3% as well, both with no monthly fees. Marcus by Goldman Sachs is worth mentioning specifically because of what it doesn't have: no fees and no minimums at all. If you want the simplest possible version of this, that's the one with the fewest strings attached. Synchrony Bank's online high yield savings pays 3.3%. It's free to open and charges no monthly fees, and that rate is more than 8 times the national average. Moving up, Basque Bank sits around 3.75%, and Western Alliance Bank pays 3.80% with no monthly fees and no minimum required balance. Now, let's get into the top tier. Climate First Bank pays 4.01% with a $50 minimum opening deposit. That is notable because among accounts paying 4% or more, most require a lot more money to get in the door. $50 is one of the lowest entry points at that rate. For Bright Bank is paying 4.15% as of yesterday. That is the highest widely available rate. I could verify with no conditions attached to it. No hoops, no linked checking account, no boost requirements. Axis One goes slightly higher, up to 4.21%, but that top number requires meeting specific deposit and balance conditions, usually tied to a linked checking account with direct deposit. Miss the condition and you drop to the standard rate. Now, let me give you an example of why checking the date on these lists matters. Newtek Bank was paying 4.20% with no monthly fees and no ATM fees, and it shows up near the top of almost every list you'll find. But as of July 31st, 2026, Newtek stopped accepting new applications for that account because of the demand and the move to a wait list. The rate is real. You just can't get it right now. And it's most of the videos and articles ranking for this search still list it like you can. Which brings me to the traps. There are 3, and every one of them causes people to earn less than the number they saw advertised. The first trap is tiered rates. Some accounts advertise a headline APY that only applies above a certain balance. CIT Bank's Platinum Savings is a clear example. The high API only applies to the balances of $5,000 or more. Below that threshold, you earn substantially less. The advertised number is real, but it isn't the number you get. The second trap is the boosted or promotional rate. Some banks advertise a top rate that requires you to also open a checking account, set up direct deposit, or maintain a minimum monthly deposit. If you miss the condition in any given month, your rate drops back down. Read what the boost actually requires before you count on it. The third trap is the teaser rate on a small balance. You see headlines advertising savings rates far above 4%, sometimes far, far above. Look closely at those and you'll usually find the rate applies only to the first $1,000 or the first $500, with everything above that earning a fraction of it. On a real emergency fund, your blended yield ends up nowhere near the headline. So here's how I would actually approach this. Don't chase small differences. The meaningful move is going from 0.01% to 4%. That is the $400 decision on $10,000. Moving from 4.1 to 4.2% is a $10,000 decision, and it is not worth reopening accounts over. Prioritize an account with no minimum balance requirement and no monthly fee, because a monthly fee will eat the yield difference faster than a slightly lower rate will. Verify the rate on the bank's own website the day you open the account. Every number I have given you is sourced and current as of this recording, but these rates are variable by design. And any list you find online, including this one, starts going stale immediately. That's exactly why so many of these videos ranking for this topic right now are quoting 2025 rates, and that no longer exists. And confirm the FDIC insurance directly. Every legitimate bank displays it. If you cannot find it, that alone is your answer. One more thing on timing. Rates right now are drifting downward. Since early June, 13 accounts on one major tracker changed their rates. 10 of them lowered. Only 3 raised. The Federal Reserve has now held rates steady 5 times in 2026, with the target range sitting between 3.50 and 3.75%. So these 4% rates are not guaranteed to be here in 6 months. If your money is currently earning 1 cent on the dollar, the cost of waiting is real. One last thing worth saying plainly: a high yield savings account is the right tool for short-term money, your emergency fund, a down payment you'll need within a couple of years, cash you cannot afford to see drop in value. It is not an investment vehicle at a 4%. It is not going to build wealth on its own. What it will do is stop your cash from quietly losing ground while it sits there. If your emergency fund is currently in a big bank savings account earning 1 cent on the dollar, this is one of the few genuinely free financial decisions available for you. Same money, same insurance, same access, different bank. That's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. I appreciate your viewership. Stay safe. See you in the next video.